Okay, folks, we are going to be discussing my Trader's Trinity concept, and this was one of the biggest breakthroughs I had in my price study analysis. And it's a pleasure for me to reveal this to you because it's one of those things that you don't see in the textbooks or mainstream technical analysis. But I don't recall exactly how many hours. I know it was many thousands of hours in price study I have put in over the years. But the main thing that I got out of that was the natural rhythm of the markets. You can discern this by putting plenty of chart time in. But out of all of that, this is a little gem that I treasure this because it's a very powerful concept, and it really gets to the core of where price is and where it's trying to get to. And when I was first starting out, I wanted to determine in advance where price would likely react or provide me a signal to trade off of. And I was looking for, you know, if we open up any chart of any kind of asset class and you see the major high or low or intermediate term highs and lows, and you say to yourself, man, if I just knew it was going to go to that point and trade from there to XYZ price level, I would be able to make so much money. I'd be so much more rewarding as a trader. And that was one of the biggest struggling points for me as a new trader years ago because the books highlighted in hindsight wonderful opportunities, okay, and it lulled me, I'm sure much like yourself, it lulled me into believing that simply because an indicator gave me an overbought indication or gave me a bearish divergence, it was a no-brainer sell signal. You just get in there and sell it and you hold on to it until it gives you your $1 million. And I quickly found out that it wasn't that easy. Okay, and just like you, I'm sure it was very easy for me to see on the left side of the chart how they perfectly unfolded. But what was always the barrier to me as a trader was how could I anticipate where it would unfold in the future? Okay, and to me that is market wizardry. When you can look at a chart and say, okay, well, I'm not doing anything right now, but when it gets to this level, I know I would be reasonably expecting XYZ to unfold, and I would do this or that based on that assumption and hopefully make a profit. So that was really the core of the driving force behind me developing this tool, by accident really. Introducing my Trader's Trinity. My study has always been focused on filling in the gaps, trading teachers, authors, gurus, and mentors, typically left for us retail traders. Now, whether this was by design or simply because of ignorance, I always felt a sense of being cheated, like they were holding something back. Now, Larry Williams, I studied a lot of his resources early on in my trading career, and he had the most lasting impression on me as a trader. He created an oscillator and he named it the Williams Percent R. Okay, and it was a tool that really sparked my discovery of the concept I'm sharing with you here, the Trader's Trinity. Now, I wanted to determine how, with any level of consistency, where price would most likely form a trade and not something minor, nothing like those little scalps everybody likes to see. Um, I was looking for a rather significant swing high or low to form, and that was the discovery that I found by looking at the previous week and month high and low, and looking at that range and breaking it down into portions based on how Larry Williams made his percent R indicator. What he does is he takes a percentage of range, and the oscillator, let's assume for a moment you're looking at a 10 period basis. What this indicator does is it measures where we are currently in terms of the last 10 periods. Okay, and we would base our understanding of what is overbought or oversold based on that previous range of the last 10 periods. Well, I just took all that numerology out of it and said, okay, well, if I'm looking at today's trading, where are we at in terms of last week's trading? Are we in the upper portion or the lower portion of that range? And if we're in the lower portion, you know, that would probably be an indication that it's oversold, at least on the short term, or maybe even an intermediate term. If we're in the middle of the range, it's probably indecisive, okay, and I probably want to sit on my hands and wait for a much more uh, extreme in terms of price. If we are in the upper range, okay, that would be, in by my classifications, a short-term overbought indication. Now, I was able to derive a sentiment reading on the market without having any reliance on an indicator, percent R included, and it gave me a perspective that doesn't communicate through any other medium that I've seen so far. And I've been in this business almost 20 years now, so I think you're going to find some solid insight from this concept, and it's with great pleasure that I introduce you to the Trader's Trinity. Okay, folks, we are looking at the Australian dollar Aussie USD pair. What I have plotted on here is the monthly Trinity. Okay, and what you're doing is you're taking the previous month's high, previous month's low, and calculating the Trinity based on the concepts I'm about to share. So how do you do the analysis on something like this? Well, let's go over how we can use it, and then we'll summarize it by how you can build it on your charts and walk forward into the future and do your analysis based on its understanding and the logic that goes behind it. First thing you want to know is you don't necessarily just look at the previous month's Trinity. Okay, all my concepts are generally universal, so the recurring theme that happens to appear in most of my analysis is the last three periods. Okay, the last three periods you look for swing highs and swing lows, because basically a swing high is a high with two lower highs on both sides of it, and a swing low is a low with two higher lows on either side of it. Okay, it's a three period pattern. If it's a monthly, it's going to have a high one month with the previous month being lower and the succeeding month being lower in terms of comparable highs. Same thing happens with a daily chart. A high with a lower high on either side of it, that's a swing high. Okay, well, since these are significant turning points in the marketplace, and they're usually found by novice traders and neophytes in hindsight, because they can easily go back to the left side of the chart and pick out where the swing high is called the high and low of the market. You as a trader, and how I trade, what I do is I look at the last three periods when I do my analysis. I'm not just necessarily looking at today's trading. I'm not necessarily looking at this week's trading range. I'm not looking at this month's trading range. I'm looking at the last three. I want to know where I am in terms of the last three trading periods based on whatever time frame analysis I'm using. This is a daily chart, but I'm plotting the highs and lows on the monthly basis. Okay, the vertical lines delineate each new month. Okay, for instance, we're going to use the month of July. Okay, that's denoted between this vertical line and this vertical line. Okay, notice we have a high here. Okay, I'm going to note these with just little X's. Okay, we have a high, right? And notice that prior to this high here, we have this high. Okay, and notice that we also have to the right of this high, it's right here, this high. Okay, so we have a significant price structure reference point here. Okay, This could be a long-term high. It could be an intermediate-term high, definitely. Okay, but this is how we use the Trader's Trinity. We want to look for time periods where, number one, the Trinity is broken. Okay, and what does that mean by broken? The low range and high range, okay, of the period trading analysis is being done on. And since we're starting with the monthly Trinities, we're going to be looking at the market had broke out of, okay, it broke out of the upper uh, previous month's high, okay, and since had broken, we have to look for where would be the next reference point. Okay, it's either going to come in terms of a price swing high, or it's going to go over the last three trinities, last three periods. Okay, and guess we're referencing monthly data now. Okay, I know I'm not trying to confuse you, but the daily chart is what I'm using to show the swings, because if I put a monthly chart up there, it's not going to really show you the swings I'm trying to illustrate. So if we're trading and breaking through the Trinity here, okay, we want to know what is price reaching for. Okay, if this is going to continue higher, what's it going to reach for? Well, the immediately previous Trinity level is here. Prior to that, it's here, and note the high here. Okay, so now we have three primary reference points to look for in terms of where price may be going. Okay, now assuming that we're using seasonal tendencies and long-term macro trading concepts. Okay, obviously, the first and second week of July typically has a decline in uh, stocks, currencies, commodities. That's that type of investment asset. It's just a seasonal impulse that happens. It doesn't happen all the time, but for instance, it just so happens that we're using this month and we're going to have that in the forefront of our mind. So we'd be looking for overall weakness to come in generally into the market anyway. So as this this run up here, would be looking for a retest of this high here. Okay, we have broken out of the Trinity here. So what we're going to be looking for is an area where it's going to reach for either stops, a resistance level, okay, or swing projection. And if you get all three in confluence, okay, which we're going to show in a moment, this can give you insight on how to call long-term highs and lows in the marketplace. And it's very exciting when you're able to do this, because it enables you to have a longer term perspective on your analysis and not be so caught up in the 5 minute and 15 minute, 1 hour fluctuations. Because if you can get this understanding in your repertoire, you'll be able to have a lot more confidence with trading the lower time frames in the general trade direction that this insight will give you. All right, so the monthly Trinity, and much like the previous week Trinity, which we'll cover just after this portion, whenever we see a broken Trinity, we have to get ourselves prepared for the likelihood of a major high or low forming in the marketplace. All right, so we're looking at the daily chart on the Aussie. Price runs up, blows through this previous month high, and obviously before that month the high was a little bit lower, and it took out the high here. Okay, so let's put a line on that just for a moment. Okay, you can see just enough to break through it. Okay, and then what happened? Price is adjusted, and it's correction time, and it takes it all the way through and breaks another Trinity. So now how do we use this information? Okay, we have a high in a time period when seasonally and long-term macro view of the asset classes that trade, stocks, commodities, they typically fall off and roll over in July. Well, you see that unfolding here. Okay, so any rally up from this point on, okay, would be a selling candidate. So we would be looking for a nice swing high to form, which unfolds here. Price breaks down a little bit, comes up into an optimal trade entry. Okay, now we're not going to cover optimal trade entry in this module, but we're using the Trader's Trinity to get ourselves in sync with price. So let's go back to this high for a moment before we build on it. We had the old high here, 2 previous months violated, broken out. The way we get projections once price breaks out of the Trinity, okay, many times you'll see price within the Trinity. That means the previous month high and low. But when it does break out, okay, you have to take in consideration of the Fibonacci. And that is taking the high of the Trinity, put your fib on it, drag it down to the low, which would be the previous month's low. Okay, and the two levels you're always going to be focusing on are the 162 extension and the 200 extension. Okay, those two levels will always have some kind of reaction or correction, and you can use this to get some really cool targets, and you can also use it, which we'll talk about later on in a different module, how you can use these areas to also get into a trade. But so we had a projection of 162 here, previous month's high, this old high taken out. Once the Trinity was broken rather, we would look for a correction at that point to go back into consolidation. And the next month in August, okay, we saw price do a radical repricing. Okay, they took price down below previous month's low here and this low in here. Okay, because you're always looking at the last three. In other words, the reference point you're looking at now, previous two as well. All right. So now we had this Trinity broken. Okay, because we went below the month, the low here. This month references this level here. So this low equates to this Trinity's low, because when you plot these lines, okay, it's referencing the previous month or period that we're referring to, and these are monthly Trinities, so bear that in mind. Okay, so once price breaks out of the Trinity, which it does here, and retests, how do we know how far it will go? Well, you take the low, because now price is below the monthly low, so you're going to take the low up to the high, and that will give you your fib extension. And what level are we looking for? The 162 or the 200? Okay, here's the 200 level, which essentially almost caught the absolute low swing. And notice there's no reference points over here to go to. Okay, this is why I just focus on the fib extensions, 162 and 200. Okay, so we can get a reasonable expectation of a low to form in this area here. And price trades back up into the Trinity here. Okay, so now we have a high pulling back into fair value range, because here's fair value is the yellow line or equilibrium or midway point of the previous month. Okay, we trade into a new month, we make the high and trades off. Okay, so now we can get ourselves in sync with shorting the market. Why? What gives you that indication? Well, number one, we had these long-term lows in here on a daily basis now, because again we're looking at a daily chart. Once this breaks down below that, what has happened? Market structure, market flow, they both have now been taken to the downside. In other words, things are bearish now. So any rallies from this point will set up swing trades going lower. Okay, so in here, here's fair value. All right, above fair value is the sell zone. Okay, sell zone could be anywhere from this point to here, and obviously anywhere up in this area here. Okay, think like the pivot zone. This would be like a sell zone or overbought. That's really what I'm trying to illustrate here. So when price trades up into this, okay, we are now what would be considered sentimentally based on previous month's high and low range. We would consider this an absolute overbought indication. All right, and notice we don't have any indicators down here. No oscillators, no RSI, no Williams percent R, no stochastics, none of that. We're just relying on price to indicate whether we're overbought or oversold, because if you use indicators, it's lagging. Okay, so we can foresee this range Okay, if in other words, if you were just blocking off from this X here to the right of the chart, take that all out. And if you were just looking at the chart here, okay, as soon as we change over to a new month, the pivot, I'm sorry, not the pivot, the Trinity, we would have ourselves trading already in the upper portion of the previous month's range. So we would be essentially overbought. So anything that we could find on the sell side of things would and or should be expected as a high probability, low risk trade setup. Okay, so we're not going to pull it up, but here's an optimal trade entry, which so happens to fall right at the upper boundary of the no man's land, or um, this whole area in here. You don't want to be taking any kind of trades in this basis unless you have the higher time frame analysis, and this is illustrating the importance of that. But you can trade this level if you have optimal trade entry and you're getting in sync with the higher time frame. Okay, and then you would look for price to break down and at least try to reach for, okay, the low that was made in here. Here's the low, previous month's low here, referenced by this Trinity here. Okay, so we can be short, looking for a test of the previous month using the Trinity because we got ourselves in sync with the higher time frame. But how can we expect to make even more profits should the fib, not a fib, the Trinity be broken on the lower side? Same concept. You take the low, pull it up to the high. Okay. Now we have the high and the low. Here's the 127 extension. So I have to squinch our chart up just a little bit. Okay. And we have the 162 down here and the 200 extension down here. So once this low is taken out, again, we have all indications that the price should be moving lower. Okay, so and we're going to be looking for selling opportunities going into new trading periods. These are long-term profit potential targets. Okay, I know it's rather far away from where the chart's trading now, but it's something that we have to have in our minds as long-term analysis concept traders. So you can see how my price had broken down, made a long-term swing high, high, lower high, lower high. Price breaks down, trades back up into retest of this high. This is the reason why you take some profits off, guys, because you don't know when it's going to do this. This is a huge retracement. So if you're in this move, okay, you're in this move short from here, why would you want to give all that up? You want to take some profits down in here. Okay, once we break this low in here, take some profits off. All right. Now, this low in here, if you look at lower time frames, you can get all kinds of analysis to support indication. Look for indications to take profits or tighten up stops if you're reaching in this level here. And it's real. I'm going to just drop it real quick so you can see it. This low to this high. Okay, here's the low to this high. Here's the 161 extension, which essentially nails that low. Okay, so don't just focus on the monthly Trinity. Okay, the monthly Trinity is going to give you the major points. Okay, but you use the previous week and what we're going to learn later on, the previous day's Traders Trinity, to give you all kinds of insight on extensions and targets and when price should actually be reversing when it's outside of the Trinity. Alright, so now we have that. Let's take these fibs off. Now realize, if this is something new to you, you're not going to get this the first time watching this, okay? And it's something that it has to be trained and seen by repetition, okay? So my only advice to you is use these levels, study them, look at historical price data, Okay, and you'll see how they influence price. But you don't look just necessarily at today's or this period's Trinity. You look at the last three. Okay, the last three, because those levels that were in the previous Trinities, okay, will eventually have an impact on price. Okay, just like how I use the pivot points when I'm trading pivots, I don't look at just today's pivots. I look at the last three periods: today, the day before, and the day prior to that. So I'm looking at 3 days worth of pivots. I'm looking at 3 days worth of intraday highs and lows. I'm looking at key swing points in the marketplace, and the way they jump out of the chart is you don't just look at a small little myopic view of today's data or the last 4 hours of trading. You got to look at the higher time frame and see where we are in relationship to that. Okay, so when price trades back up into fair value, okay, and gets into the sell zone again, here's the upper boundary, which is previous month's high. Okay, we could be looking for weakness again to come into the marketplace. Notice that we did not, okay, break market structure to the upside. We had everything still going lower. So this is just another opportunity to get short. Okay, now price has traded lower. Opportunities to get short in here, in here. So when price is below the fair value line, which is the yellow line, in this region, you want to be focusing on buy signals. When it's above the yellow line, okay, which is fair value, this is when you want to be looking for sell signals. Okay, but you have to look at the higher time frame to look for the most high probability trades. If we are looking for opportunities to get short, which in here, okay, say you missed it and price starts to break down, now we're below fair value. Does that mean you've missed any kind of trading opportunity? No. Okay, you look at the lower time frame, what would be in the buy zone. These levels will act as resistance, not necessarily just support. They will act as resistance, as you see here. Okay, and you can see how, controversially, if market's trading higher, okay, this would be considered the sell zone, but these levels now are traded as support. Okay, so you have to be able to flip your understanding of what these levels will do, just same way you do with standard price support and resistance. Once price support is broken, it trades back up to it. What does that support become now? Resistance. All right. So what have we covered so far before we go on to the previous week Trinity? For the monthly Trinities, you want to look for broken Trinities and then wait for price to reach an extension on the fib, as we illustrated here. Okay, and here, wait for price to reach this extension, which is 162 and 200 extension, and then price will correct and pull back into a trader's Trinity going into the new period, which will be this month here, or the next month, whatever you're trading. And I know this is kind of confusing, but as we build on this will make more sense as it go. So let's take a look at how we can use this insight with previous week's Trinity. Okay, we're going to have to drill down to, let's look at, we're going to be looking at August, September, October time frame. So let's look at a 4-hour. Okay, here's that long-term high, that lower high. So we have that longer-term swing high. It's in formation. And as we close the situation that I have zoomed in here, we'll look at a zoomed out perspective. You can see these highs where it makes the swing high on the daily and weekly chart, and it'll be very clear to you as to why I'm illustrating this. Okay, we have Trader's Trinity on the previous week. All right, we have the same thing unfolding here. Price is now above. Okay, it's above the Trinity. It's broken. Okay, Prices above the Trinity here, it's broken. Prices below the Trinity lows, it's broken. Okay, above it here, it's broken. How can we arrive at where price is going to reverse here? Because you can't really see any kind of real clear indication of what it was reaching for, right? I mean, I can see you're scratching your head and thinking, okay, well, this isn't making much sense yet. Let me see, you know, what's he going to do at this high here? Because I don't see your optimal trade entry there. I don't see any kind of level back in here. You're right. But what did I just show you on the monthly Trinity? Once you break the upper boundary, you take the pivot, the fib, pull it from that high, which is the previous month, previous week now because we're using previous week's data to make the Trinity on the weekly basis. You're using the high and the low of the previous week. So you're going to take the high of last week here, pull it down to the low. Okay, here's the 162 and the 200. Okay, and there's the high that unfolded. Okay, nothing except for using the fib extensions. All right, if you see this happening, okay, you can drill down to a lower time frame and you'll be able to find optimal trade entries in here then. Okay, but this sets the stage for a turning point that you can expect to see unfold. All right. All right, this low down here, remember we were referring to that the monthly Trinity didn't call that low, but yet it reversed. Okay, well, we would be using this Trinity low, which is this previous week's low here, and here's the high. Okay, so that's why you have this level here, which is that week's high, this week's low. So here's your Trinity here. We broke down. So how far is it going to go? We can reasonably expect it to stop trading at the 200 or 162 extension. Now monthly failed to do it, but look what happened here. 162 nails it. Okay. This goes even in greater accuracy when we start looking at the daily Trinities and how we can project the fibs from it, but we're not going to do that yet. We're still working with the weekly here. Okay, so we had a swing here, price trades up. Now, when you get yourself in sync with the higher time frame trend or flow or market structure, okay, you want to be focusing on times where price is giving you indications that it will now get in sync with that higher time frame analysis. Here, you can see how price trades up from extremely oversold, being underneath the Trinity, trades up into, well, we're in a sell zone. Okay, this is a sell zone going into this week. But look what happens. It finds support. Okay, it finds support in here. So how can you use that? Well, we haven't had any kind of indication that we've made it up a topside reversal yet. But let's look at this here, where we could trade this low. This high down to this low, using the same concept that we just used, using the swing projection for lows here. Let's try to find the high here, see if it still holds up. We're above the high, so you take the Trinity high, pull it down with the fib onto the low, drop that there. Okay, and we have the 127 extension in here. All right, we have the previous buy zone level in here, and go one more period before that. Okay, you have dead space. Okay, now this level could have been an impact, but we're not going to refer to it here. This this extension allowed price to pull back into. Okay, notice we didn't reach out to 162. We didn't reach out to 200. So what does that mean? It's not done yet. It's not reached its um, fulfillment. Whatever it is up here fundamentally it's driving price up here, I don't need to know that. All I know is it's eventually going to get to these levels, and then you'll have a correction of some magnitude. All right, so if we're just looking at price at this point, one could look and say, okay, we failed to get here, but these levels are significant. So let me put those on my chart. And should price trade to these levels at some point? This is the reason why you guys have to have a journal, man. It's not about just keeping track of how you feel about your trade. You want to make notes, okay, and keep reference points on your charts. Once price gets to these levels, you want to have a game plan. What are you going to do when it gets there? So this level here and this level here, should price ever get to it, should be significant. What do you call that? You can't get any closer than that, guys. Okay? So, once again, you're going to be looking for the turn or significant high or low to be formed at the 162 or 200 extension on the monthly and or the weekly. If the Trinity's broken, okay, you use these extensions to give you your turning points, okay, the stage of when it's going to unfold. Now, when price starts to trade softer and goes lower, okay, as it does in here, everything is going back in sync with price. If you note also that we've now slipped much lower than the previous week's low, which is here. If we go below it, okay, and trades back up to, where's it trade to? Fair value. Okay, this middle blue line here is equilibrium or fair value. All right. In here, we can find an outflow trade entry in here. But how far can we reasonably expect price to go once it breaks down? Well, if we already determined how we can use it to find turning points once it's broken and reached out far beyond the Trinity, we can use this concept now to reach for downside targets by using the low up to the high. Here's the 162 extension. Okay, price gave a little bit of a bounce here. 200 extension. Okay, and this is a really good level because not only is it 200 here in dead space, but go to the left. You have this low and almost 50% between here. But I like this confluence of levels like this. Okay, note we have not used pivots. We haven't used anything else except for price structure and Trinity concepts. Okay, but going to the right, you can see how price had a difficulty. We've already used this line, so we can now borrow it, put it down here on the 200 extension. Now, as price breaks down, we would look for price to either bounce here, and if it goes through it, trade back to it as now broken support become resistance. Okay, and you can see how that gave you an opportunity to get some another push down. Price was unable to make any attempt to get back above it here. Okay, so again, we're below the trader's Trinity. Here's the Trinity. We're well below it. Okay, so how do we use that information? You take your fib, high, low, okay, because you're pulling the low up to the high. Okay, here's your 162 and your 200 extension, which nails the absolute low of the market right here. And it gave you 1, 2, didn't quite get it on this candle, didn't quite get it here, but look how it stops it, like right to the pip. I mean, it's amazing how accurate this is. So price is now pulling back, bounces off of it, exactly what was this described on the previous extensions. When the Trinity's broken, this is how you use it. You look for the turns to correct back into a new trading period where it goes into inside the Trinity, which is what we have here. Price trades back up to, where does it go? Fair value or equilibrium. Okay, and then still again price structure and market analysis concepts on the higher time frame suggest lower prices. So we would be still looking for sell signals, okay, and not just simply relying on the overbought, oversold. Okay, this is how, um, if you just follow indicators, it burns you, because you could be oversold and oversold and oversold and still give you sell signals. It's not simply oversold to give you a buy signal. It's oversold telling you we're in a very strong down move, and focus on looking for shorts, and not necessarily just the fact that we're oversold. We're looking for a pop in the market. It doesn't always unfold that way, and I'm sure you probably have experienced that. But you can see an optimal trade entry in here. Okay, if you were to plot the fib, which I'm not going to do here. And again, I'm showing this on a pair I really don't trade that much, just to illustrate that it doesn't just work with the two pairs I love to trade the most, which is the fiber Euro USD and cable, which is British Pound USD pair. All right, so I'm kind of using an odd pair, but it is a major, because my premise is to keep you focused on the majors, because the central banks are going to control every pair, cross and everything with the majors. So if you're going to focus on doing your analysis, it makes perfect sense to do your analysis on the majors, because if you start looking at crosses and you haven't referred to at least the majors, you're looking at half the book. You know, you're not going to have the full picture. So looking at what we have here, price is broken out of the Trinity here. Okay, we've got extensions calling the low here. Now we're trading within an area where we're below the Trinity again. We trade back up into fair value to give us a short. Okay, remember I was telling you, um, for those who have been fortunate enough to be part of our thread for any length of time since August timeframe, I released the Trinity concept. You only want to be trading in the fair value region or equilibrium point of the matrix, which is these three blue lines here. This is the weekly matrix. Okay, this is the no man's land. The only time you want to trade in that region, okay, is if you're going to be scalping, okay, which is not what we're going to talk about in this module, or you're getting yourself in sync with the higher time frame, and that's what this is doing. See, it went right up to fair value. Okay, the long term is down, so it's going back up to fair value. Why? Because they want to get more opportunities to get short, and they sell off again. Same thing you see here. Price trades up into where? Fair value. I'm not telling you not to trade in fair value, okay, ever. I'm telling you, if you're going to trade, look for it to give you opportunities to get in sync with the higher time frame. Okay, we had a significant shift in price. Price trades back into fair value. Well, it runs higher. Okay, why did it run higher? We already showed that it didn't reach that extension once the Trinities had been broken. If it didn't make the 162 or 200 extension, it's not done yet. Okay, it's not done. Now, one could argue that this could be done by the notion that it's reached 162 and 200 extension when this Trinity was broken. Okay, but where are we at? Are we in a bullish market? No, you can't. Don't try to pick the bottoms. Don't do that, because you'll leave all this money on the table. Okay, this is just going to give you an buying opportunity to get another short sell underway. Okay, if you plot the this high in here down to this low, this will give you optimal trade entry again, getting short. Isn't it cute how they take this market right up above these highs? Because what are you doing with this market if you're short? You're putting your sell stop, your buy stop on any short positions right above these highs. So they're just going to become, they want to be complete, right? They want to make sure that they got everybody. So they'll come up here, sweep above that, take you all out, and then they'll sink it again. Okay? And then you have this precipitous fall off here. You have optimal trade entry in here, getting short, trading at the fair value with the higher time frame analysis in sync. So everything is now looking for lower prices, and then we have the extrapolated move down. All right, and you can do your extensions on the low and high. Okay, 162 and 200. Again, well beyond. Okay, well beyond, because we are now in sync with the overall market structure and trend. When you trade in this direction using this concept, you're going to find that your trades will absolutely go beyond your targets. Okay, and one of the coolest things that I heard when I was at Larry Williams' workshops was that when you're in sync with the moves that are really driving the market, they will always go well beyond where you think they're going to go. And that's a good feeling. So that's why I always try to leave a little bit of my trade on when I'm in sync with those higher time frame moves, because you don't know, okay? You don't know how far they're going to go. And in the mid 90s, the currency markets were in a tear. I mean, they were going up like crazy. And I was fortunate enough to capture, a big chunk of the yen. And yeah, no, the yen is one of the pairs I don't like now. But there was a time when it was moving like crazy, and it was easy to make money with it because I was using this type of concept and letting my market, pay me. I didn't try to, squeeze out because it moved up, 300 basis points. It's just going to top out. No, man, you just got to let it run, and this is what you end up doing. Also, what I'll toss this out there for your position traders and swing traders on the higher time frames. If you want a really good idea where to place your stop loss orders, okay, you want to use the last three. Look at the last three periods. Today, no, well, not today. This would be previous week's Trinities. Okay, you want to look at this week's Trinity, previous week Trinity, and the week before it. Okay, and you want to find the highest high within those three Trinities. Okay, and that's where you want to trail your stop at. If you're going to be trailing stops, that's how you do it. Okay. And if you want a real quick, easy, dirty way of doing it, also is use your 15-minute time frame and use the last two swing highs for shorts and go whichever one's highest. Go back to that one and go about 10, 15 pips above it, and that's where you want to trail stops. I mean, if you're getting in there and you're trailing at 30 pips, and just intraday static alone can take you out of the market with that. So, but I'm going down a rabbit trail now, so let's go forward back to the Trinity as we use it here. All right, so we have uh, markets breaking down. It peters out, starts to consolidate. Okay, it trades back up to where fair value, and this extension right here. This is the one that you're familiar with on. If you've been to my seminar over the summertime, I think it was the latter portion of August. I want to say it was the last week of August, but I don't recall exactly what the top of my head was. But a few of you were there, and this one here is this is the absolute farthest one that I've seen price go to, and then it stalls. And I use this one because it's based on some GAN studies, and Larry Williams brought out a tool in his workshop, and I've been trying to figure out how I can teach it to you because it's an overlay. It's a little piece of plastic I use, like remember when you're in school and they used the overhead projector, and they would project the image on it, and they'd write on this little piece of film. Well, I use this. It's like an overlay for an overhead, and it's got some angles on it. And as soon as I can figure out how I can communicate that to you through this medium, um, I'll do that. But I use this fib because it comes very close to the same general target extension. Larry Williams used this thing called the target shooter, and he didn't go into how it was constructed. I got it when I went to his seminar, and then I started studying it and looking at it, and it has a lot to do with GAN and Fibonacci, and it's really cool. But if you just have the extension 423.6 on your Fibonacci, that's for an extension. This is probably the on your very extrapolated moves that go out like crazy. That's the level they pretty much go to. And to illustrate that, what we're going to do is drop a line on it, and you can see it pretty much caused the low right here, and then we bounced, and it traded up into fair value, and then gave you what? Another sell off. Okay, so here we have price breaking below the Trinity again, and we use the low to high once again to the pip 162 extension, calling the very low of the market. Okay, and we can use these levels always to find how far price will reach for, and then eventually expect a turn. All right, so let's look at this one here. Here's the high because we're outside the Trinity. Let's pull the fib down. Okay, and here's the 200 extension. All right, narrowing your focus and patience. All right, look for converging overbought zones on the monthly, weekly, and daily Trinities for no-brainer short sell setups for swing trades and or intraday trading. Now, what do I mean by converging overbought zones? Okay, well, if you have an overbought zone on your trader Trinity on the monthly basis, and your pivots are trading at the overbought reading on your monthly Trinity overbought, and price is trading up in that region, okay, that's a converging overbought zone. It could be weekly and pivot region overlapping, converging. Okay, so you have pivots giving you an indication that we're probably overbought. You have the trader's Trinity indicating you're probably overbought. Okay, so you have price really pulled away from fair value. Okay, so there's going to be a reasonable expectation that a repricing shall come on their way, and price will try to get back to the central pivot on the pivots, or it'll try to get back to the trader's Trinity's fair value level. Okay, and we're in that range. That's where the opportunity lies. Okay, now looking for converging oversold zones on the monthly, weekly, and daily Trinity. Okay, this is also a no-brainer for long setups for swing trades and or intraday trading. Just like we shown how you use the previous month high and low for the monthly Trinity, breaking it down, you can do the same thing for the weekly Trinity, using the previous week's high and low and breaking it down. The same thing can be done on the previous day's trading, okay, and where we're at in relationship to that, using the same Fibonacci extensions if we're below or above the extension of the high and low, and you can reasonably expect a swing to unfold at those levels. The key is to have the convergence and confluence of supporting notions that we are overbought and oversold. Then, if you start looking at your indicators, if we're oversold based on this premise, and indicators are giving you bullish divergence and oversold indications, then you can have a lot more reliance on your indicators. I think you'll have a lot more success trading with them. Now, trading in the middle of the Trinity presents a higher odds of being stopped out. You're close to fair value. There's a whole lot of discerning of where the next move is going to be by all kinds of traders, and it's actually the accumulation stage of the range. Okay, so think like the Asian range, how it consolidates and makes the base for the next move. If you're trading within that fair value zone or middle portion of the Trinity, you're understand that you're in that accumulation portion of the range, and you could get stopped out very easily if you're not right with your directional premise. So how do we fix this or overcome that? You trade in this region when you have the higher time frame analysis perspective in mind. Okay, so if you're going to trade in this region, obviously you're going to be looking at the higher time frame for your directional bias, and or if you're just going to be a short-term trader and scalp raids on stops, previous highs and lows on a short-term basis intraday, catching 15, 20, 30 pips, obviously go right ahead and knock your socks off. But you know, outside of that, this is just one more concept to include in your arsenal, and it gives you a very solid approach to determining what overbought and oversold really is, and when we do get extreme readings on the Trinity, how we can foresee significant price highs and lows to unfold in the marketplace.